My name is Brianna K Gibson, and I'll be forecasting one-year interest rates and analyzing the yield curve for the week of March 18th to March 22nd, 2013. This graph is the change in rates from Monday to Friday. It was a pretty eventful week. We can see quite a bit of activity, especially at the longer term end of the curve. The highlights for the week were that the entire yield curve fell. The rates on securities farther from maturity decreased more than those closer to maturity. The curve flattened slightly over the course of the week. The average percentage change in rates over this period was a decrease of 2.31%. And by that, I mean I calculated the percentage change for that period for each year's rates. The 1-year rate all the way up to the 16-year rate. And I averaged those percentage changes to come up with this number, 2.31%. This volatility in Treasury rates can be explained in major part by the Federal Reserve press release and the Cyprus bailout. Investors chose to put their money into less risky investments in response to uncertainty brought on by the Cyprus financial crisis, pulling the Treasury rates down. This is my forecast for one-year interest rates out until 2028. There is a steady increase in rates for the next 10 years, and then it begins to fall. Overall, my forecast from Monday to Friday decreased. So the decrease in yield curve rate means a lower forecasted one-year rates using the expectations hypothesis. The net effect on expectations for one-year rates was a decrease on average of 2%. This forecast projects that one-year rates will rise for the next 10 years and then fall. This huge drop in projections is a result of Federal Reserve manipulation of interest rates. The Fed is keeping 10-year rates especially low because mortgage rates are determined based upon this rate. As a result of this manipulation, the forecast is not a fair representation of future rates. Monday to Tuesday, we saw the biggest change in rates. The two curves begins to split very low on the curve. Tuesday, the curve reached its lowest point for the period. The entire yield curve fell. The average change in interest rates for this day was a decrease of 3.22% compared to the average of 2.31% for the week. The dramatic drop in rates can be explained by market concerns surrounding the Cyprus bailout. On Monday, the Dow dropped 0.4%, the Standard & Poor's index fell 0.6%, and the NASDAQ Composite Index dropped 0.4%. The markets were all down in response to this event. Investors wanted less volatile investments, increasing the supply of vulnerable funds in bond markets. The 2-10 spread fell to 1.658% from 1.698% the previous day. This is a graph of the change from Tuesday to Wednesday. On this day, rates actually rose. The entire yield curve lifted on average. The percentage increase in rates was 1.25%. On Wednesday, the Dow Jones rose 55.91 points, or 0.4%, to the Standard & Poor's 500 index rose 10.37 points, or 0.7%. The Nasdaq Composite Index rose by 0.8%. Investor fear of the Cyprus crisis faded, encouraging them to put their money back into equity and decreasing the supply of loanable funds in bond markets. The market is offering a higher return on these securities because of the decrease in supply. Following the Fed's largely unchanged policy, yields on benchmark 10-year U.S. Treasury notes rose 4 basis points. The yield has been as high as 1.98 earlier this week, but fell to around 1.93% after the Fed statement. This graph snapshots the change from Wednesday to Thursday, and the two lines almost look like one. There wasn't much activity on this day. The yield curve flattened from Wednesday to Thursday. The rates did not follow a uniform trend, however. Rates on securities 9 years and further from maturity decreased, while those on securities 8 years and closer to maturity increased. Investors are putting more of their money into longer-term securities and less into shorter-term securities because they are expecting rates to drop. These future expectations of low rates can be explained by the Fed's announcement on Wednesday, March 20, 2013, that it will continue to pump money into the economy and keep rates low. The net effect on the yield curve was an average increase in rates of 0.68%. Yields on the benchmark 10-year U.S. Treasury note fell 3 basis points to 1.92%. So looking at the change from Thursday to Friday, there wasn't much activity this day either. Rates on treasuries at all maturities decreased this day, however. Feeling more optimistic about the financial crisis, they put more of their money into the markets. On Friday, the Dow Jones Industrial Average rose 0.6%, the Standard & Poor's Index closed up 0.7%, and the Nasdaq Composite Average closed up 0.7%. As their bond purchasing program, on Friday, March 22, 2013, the Fed brought $3.28 billion in debt maturing in 2018 and 2020. Also contributing to the drop in yields on the benchmark 10-year U.S. Treasury note were flat at 1.92%. In conclusion, the yield curve rates have dropped and the curve overall has flattened. The Cyprus crisis sparked uncertainty in the market and pushed investors to put their money into U.S. Treasuries, which are believed to be a safe haven. The Fed announced that it would continue to stimulate the economy by purchasing mortgage-backed securities and longer-term treasuries. It believes that even though the economy is looking healthier, it could still use some help.